Good afternoon, everyone, and welcome to this month's installment of our Epic Insights. This is John Rice. I'm the Southeastern Regional Sales Consultant, and I am a co-host and co-presenter with my regional president and consulting actuary, Joan McCabe. So Joan is based and heads up our actuarial team out of Maine and has served on the IRS Advisory Committee for tax-exempt and government entities, and also is a member of the National Center of Employee Ownership, the Maine Employee Benefits Council, and the American Academy of Actuaries, ASPA, and associate of the Society of Actuaries. So with her bio, mine is much smaller. So with that, I just want to give a quick reminder of what we're here to do today and kind of how our webinars work. So everybody's in listen-only mode, and so we'll have the panel open on the GoToWebinar that'll allow you to ask questions, and we'll take some of those questions at the end, time permitting. And if we don't get to your question, then we'll be happy to have your regional sales consultant follow up with you. So one of the items that we really want to talk about is tax reform. So if you just think of tax reform as it's affected business in general across the country, the question that we're posing today is, are cash balance plans right for you and your clients? And maybe the key indication there is, are they still right for you and your clients? And I think as we go through this, we're going to really see how it can affect, the advisors and trust clients that we work with and their retirement plan clients. So when you think of the tax benefits, historically, cash balance plans are a huge tax play. Whether you're a professional services firm and you're able to put away $200,000 and $300,000 for the individual partners at a much lower staff cost, there's just been a tremendous surge in cash balance plans. And recent studies have said there's over $1 trillion in cash balance plans today. But with the Tax Cuts and Jobs Act, and we've had a lot of conversations about this in the media, how does that affect it? So what does it do to these passive entities? And, we already ask a lot of questions when we're setting up cash balance plans, but what does this mean? So how can we leverage this today? And kind of one of the things that I and my sales consultant colleagues answer all the time is advisors love the concept of cash balance, but they're like, just get me started. Help me bring this conversation to the forefront, involve the tax professional, and get the necessary information over to our actuaries so we can really dazzle them with all the tax benefits they can have. And probably my favorite part of this is the Epic family of companies, which Joan is our regional president on the actuarial side. We're here to help. And, no plan is too small. We do solo cash balance plans all the way up to very large firms. So I think that's the real takeaway and the excitement that we have around these. One of the things that in the beginning of the conversation, a lot of the target marketing, if you will, centers around the 401k plan, the existing DC plan, and how you add on a cash balance to it. So when you think of the basics of a cash balance, they pair very well with the profit sharing components within the 401k and the DC plans. So I like to look at this as a building blocks conversation. Cash balance don't fit everyone, but when they do, they're tremendous. And a few of the things that, just to kind of remember is that when you pair the two together, you can put some of the contribution to cover all employees in the 401k and leverage that into the cash balance. And we have a couple of illustrations to help with that. And then if you think of the very last bullet, when you look at law firms and professional services, medical practices, a lot of the risk mitigation that they're looking for is if they do have a lot of assets in their partnership or in their association or LLC, how can they protect that from creditors? Because they do understand the true risks. So this is something to remember. The main difference between this and non-qualified plans remain the assets of the employers and are subject to creditors. So cash balance are trust assets, and they are protected from creditors. Now, one of the slides that we have this in a value piece, and we use to start the conversation, advisors and trust and wealth departments, they really understand personal savings. So you start with, I'm working with my individual client. You have enough to put in your IRA for maybe you and your spouse, and you get the personal savings scenario. But if you start with the building blocks and moving up the mountains, at some point, the IRA is not putting away enough, and the company is successful. So you add on a traditional 401k plan. And then the next piece of the puzzle is you add a safe harbor provision so that the owners can maximize their tax deferred or their 401k or Roth contributions. Well, when that's not enough money, then we layer on a profit sharing element to that same 401k plan. So now you have the 401k or deferrals or Roth contributions plus the safe harbor plus the profit sharing. Well, if you're over 50, you can get up to $61,000. If you're under 50, you can get $55,000 individually for an owner. But you will get those opportunities to where the owner is looking to put away more. So if I have more than $61,000 to put in my own account, what can I do? And then that's when we add on the cash balance next to the 401k profit sharing to get the top of the mountain. And I think if I move to the bar chart version of that, you can kind of see what the difference is in the accumulation. So if you look at, because we are approaching retirement, and this is replacement income that you're looking at new comparability and then cash balance, you see as you approach the retirement age of 65, that's where you can get the maximum contribution. That $61,000 that's in the lighter shade color, which is your maximum DC or 401k and profit sharing contribution, you can see the significant difference that cash balance offers. And so cash balance with that tax deferred nature then can be brought into the wealth practices so that you can roll it over to an IRA and help them with the decumulation strategy. So I think it's important to know that this is a supercharged retirement plan, but it really helps you with your practice. One of the things that we get frequently from our various partners, and we thank you for your business out there across the land, is where can we hold the assets? And, if you work with a certain custodian, we have the flexibility of working with you and that custodian. We've worked out with a wide variety of companies to be able to have you manage those assets and feed us the electronic data. So our actuaries are going to look at the performance of the trust, and then that also helps us prepare the actuarial reports annually. We're usually using either a 4 or 5% crediting rate, so that is your targeted return inside the portfolio. And we also have some folks that ask for assistance. So maybe they have a lot of practice within the 401k, but they've already leveraged an outside fiduciary. So can I also do the same thing? Get an investment manager or a 338 fiduciary for cash balance. And we do have partners that do that today. So contact your sales consultant. We'd be happy to help you with that. One of the key components to remember within a cash balance, because these are defined benefit plans, is the participants do have the ability to take pension payments from the trust, so they could get a monthly recurring payment. The nice feature of it, especially in the wealth practice and financial planning, is they can roll it over like an IRA rollover, so it remains tax deferred. So I think a lot of us consider the rollover as the primary reason, but if you do have somebody that sets up pension payments, a lot of the custodians we work with make that easy. Or we work with CPA firms and the like that can do the Form 945 and the 1099. So I think, that's just kind of the table setting is the part of the presentation I wanted to do. But the next piece of the puzzle is, we're going to actually poll the audience because we like crowd interaction, and we thank you for being on our webinar today. So, Chris, if you want to kick off the poll, what we're going to do is ask, what do you think the Tax Cuts and Jobs Act or tax reform is going to do to cash balance plans? Is that going to make it more attractive, less attractive? So will it make the cash balance plans less attractive? Yes, no, or maybe. So you should be able to indicate your choice. And this really is to kind of get where our audience is thinking, and that helps Joan as she gets into the technical part maybe understand. So we're going to leave this poll open for probably another 20 seconds or so because everybody can do it, and then we're going to put the results on screen if the magic of webinars works, and let everybody kind of see what the nation is thinking. All right, Chris, I think if you click it, we get to see the results, correct? Or does it go back? It looks like it's gone back. There's the polling results. So if I could see that, it looks like maybe it's the kind of the overwhelming answer. No, it doesn't make plans less attractive, and yes, it makes plans less attractive. So I think I appreciate everybody contributing to that, and hopefully that was easy to do. And I think the next slide is where, Joan, you get to dive into the details and tell us, is it going to make them more or less attractive? And Joan, you may be on mute. I'm not sure.
Okay, I'm here. Good afternoon. Thanks for joining us, everybody. Glad you could join us on this really warm, steamy afternoon in Maine, which is pretty rare. But I want to talk a little bit about what tax reform has done in the realm of qualified plans in general, but with a particular emphasis on cash balance plans. Last year, just about to this day, I believe, we did a cash balance webinar just like this and concentrated more on the basics of cash balance. As those of you who are on that webinar, and many of you probably know, the number of cash balance plans has been on the rise over the past decade or so, in large part due to the Pension Protection Act, which gave us clarity in the law and approval by the IRS, which we had been missing. And while there are many benefits to sponsoring a cash balance plan, the bottom line is that their popularity, as opposed to other types of qualified retirement plans, is that they are all about the taxes. So it's important to understand and consider the new tax law as we go forward. What this new tax law really does is it really changes the calculus that goes into analyzing whether or not a retirement plan is good for someone's business. And we'll talk a little bit about that and focus on that today. So to start with, I thought we ought to go back and remember where these tax savings come from. With qualified plans, it's really about the deferral of tax. The deferral of tax on the contributions that go into the plan, and the deferral of the tax on the investment income that's earned while the plan is in place. The deferral of the tax deduction of contributions gets compared to what we historically have done is compare the taxation of the contributions that go into the plan and the deduction is taken and the rate it's taken at versus the tax rate that's paid when the money is distributed from the plan, which is typically after retirement is the idea, and is typically in a lower income tax year. So let's see what's really changed. The contribution in and the contribution out piece is really still in place, but what's different is the taxation of businesses. And the taxation of business does vary depending on the business structure of the company. So first of all, let's talk about the change in tax rates for corporations. With tax rates for corporations, before we had this Tax Cuts and Jobs Act, the corporate rate, and this is what most people have heard all about, one of the most talked about changes, is the reduction in the corporate tax rate, which went from 35% down to 21%. So before we had this Tax Act, there was a 35% income tax rate on the business income, but that's not where the story ends, because corporations have a double taxation where once those profits are taxed, they are distributed to the shareholders as dividends. And the shareholders pay dividends, pay income taxes and ACA surtaxes on those dividends. So the tax rate for them effectively was not really 35%, it was really just above 50%. And after tax reform, when the income tax business, the corporate income tax rate went down to 21%, after dividends, that rate fell just below 40%. So before this Tax Act, if you were a corporation, the analysis you would do is say that I'm contributing at about a 50% tax deduction rate, and when I take the money out, perhaps after retirement, the highest, I will be taxed on that at my personal income tax rate, and that tax rate at the highest under that tax law was just under 40%. So there was this tax leveling going into play. With the new tax law, that leveling has gone down quite a bit, so that the contribution in is a deduction worth just under 40%, and the deduction out at the highest tax rate, since the individual tax rates under tax reform have dropped slightly from 39.6 to 37%, but it's really more of a level playing field after tax reform for this corporate analysis. Now, on the surface, that doesn't look, it looks like a reduction in some benefits, but I think one thing we need to consider in all this is that the highest income tax rate now after tax reform, even though it's at 37%, when someone's in retirement to pay 37%, they would have to be in about the $500,000 or $600,000 taxable income range, which might be unlikely for most people. More likely, a business owner might have taxable income in the range of, let's say, $150,000 to $300,000, depending on their filing status. Then their new tax rate would be more like 24% under the new tax law. So this is a little bit deceiving. It really depends on the person's individual tax situation. But it's probably not a bad takeaway for a lot of people with corporations, perhaps a few. Now, let's look at pass-through entities. So businesses that are not structured as C corporations, typically a small business, would be a pass-through entity, which might include a sole proprietorship, an S corporation, an LLC, or a partnership, for example. These entities are not taxed at the business level, they're taxed at the personal level. So their business tax rate is their personal tax rate. So before we had tax reform, the highest tax rate for individuals that their business income would be taxed at on their 1040 would be just under 40%. And so they're putting in at 40%. The worst they'd be taking it out would be at 40%. And in a lot of cases, it would be less. With tax reform, the personal tax rate, income tax rate, has been lowered to 37%. But there is a new concept called qualified business income, or QBI, which is really changing the game on all of this for pass-through entities. And this QBI is a deduction worth 20% of your business profits, basically. And so that a business that can take advantage of the full 20% QBI deduction will effectively reduce their tax rate from 37% down to 30%. And so for pass-through entities, we have a whole lot of more different types of thinking to do on whether or not these retirement plan deductions are a good deal for them or not. So let's just look at QBI. As we said, for pass-through entities, the individual tax rate didn't change much, but this 20% deduction is very, very new. It's a very sweet tax gift to small businesses, and it was really given because Congress didn't want to provide tax reductions only to C corporations and was trying to extend it more to the small businesses. So this example is a very simple concept. It looks very simple. If a business, this is an example of a business that has a pass-through entity that has profits of $100,000. And so they would be paying at the highest individual tax rate, taxes at 37%, or $37,000 of income of business taxes. If this business qualified for the 20% deduction, they would take a $20,000 deduction off their $100,000 of profit. Therefore, they would only be paying income taxes on $29,600 and paid at the 37% rate again, gives them effectively a tax rate under 30%. So this is something that's very useful to small businesses and well received for them. So while this is a very simple illustration and a concept, the whole new concept in the tax code of QBI and the deduction is not simple. There is a lot to it. It's much more complicated than this might suggest. But I don't think it's something that anyone probably attending this webinar, unless they are a tax advisor, really needs to understand in and out. You just need to understand that there is this new concept that perhaps lowers tax rates quite a bit for pass-throughs. Now, the important part of this QBI deduction is how do you get it? Because not everybody can get it. I gotta go back.
Do you need me to scroll back?
Yeah, John, can you do control of that?
Yep, so right there?
Gotcha. No, you can go ahead. Thank you. So the QBI deduction is based on the business owner's taxable income, and that comes off of their 1040. That's not taxable income having to do just with the business. It's all in. It's all of their, if they have W-2 wages from another company, if they have a spouse and they're filing jointly, it's basically all of their taxable income combined. And so the first thing you need to do is understand how much taxable income the business owner is going to report on their 1040. And there are threshold amounts that determine how much of this deduction you're going to get. So if you are married filing jointly and your total taxable income is less than $315,000, then you will, no matter what kind of business you have, be able to get the 20% QBI deduction and therefore slash your effective tax rate down from 37 to 30. If you're filing single, that threshold is half of what it is if you're married filing jointly. That's the $157,500. On the other hand, if you are a very profitable business and you're married again, filing jointly, and you make over $415,000, or half of that if you're filing singly, you could be phased out completely of this QBI deduction. And therefore, you're basically not seeing much of a tax cut at all from this new tax law. If your income is in the middle of those two thresholds, there's just a simple pro rata phase out between if you would have been under or over those thresholds. And then the distinction between service businesses and non-service businesses is really important. You don't want to be a service business for this purpose, because if you are highly profitable over that threshold, you are not going to have any deduction. If you are a non-service business, it's possible that you can get all or part of that 20% deduction, but it is subject to some other limitations, which generally have to do, at least in our business, with how much payroll you have in your business. The idea is the IRS did not want to give tremendous tax benefits to businesses that didn't have many people employed and therefore didn't have much payroll. So those limitations are really measured based on how much W-2 income there is throughout your company. But it's possible you could get some or all of that 20% if you had enough payroll to do it. So the important things to remember in looking at this universe of pass-through entities and how they might get taxed is the left side bottom of this chart, which is outlined in red. That's really where we see our typical cash balance candidates. They are usually highly profitable businesses, and much, much, much more often than not, they are service businesses. Now, you might ask, what is a service business? This is a new definition under the tax law. SSTP is their acronym for service businesses, which stands for Specified Service Trade or Business. And it's basically a business that is engaged in health, law, accounting, consulting, financial services, actuarial. We're swept up into that too. Investment management, a lot of you are swept up into that. And these are really our typical cash balance candidates, where we have professional services being rendered. So the bottom line to this is that even though that QBI deduction is a very sweet deduction, for most people that would have been good cash balance candidates before, they're not really seeing much change in their tax situation. So just to show you an example of how this QBI deduction works, this is another simplified example. This is an owner of a pass-through entity, which I'm calling an LLC. This person files their taxes as a single person, and this assumption is that this LLC produces $200,000 of taxable income from the business. I assume that this person has no other income, no other W-2 income. If they had investment income, that would be in these numbers as well. I've ignored that for this purpose, but that would be part of that taxable income number if they did have investment income. So this person without any pension plan would have net taxable income of $200,000 and would pay that $200,000 taxes on that amount based on individual tax rates. If instead they had a pension plan and made a $55,000 pension contribution, so I've kind of used an example of somebody maximizing a defined contribution type of plan rather than a cash balance in this example. But you can see that just the deduction for the $55,000 contribution brings their net taxable income down to $145,000. Well, based on the QBI chart and the thresholds, if someone is single and they have taxable income over $157,500, they're not going to be able to get the 20% QBI. When we reduce the net taxable income to $145,000, that's under the threshold for the single filer, and they're entitled to the full 20% deduction on the QBI. And so the pension contribution reduces it. The QBI deduction reduces their taxable income even more. And so that $55,000 contribution results in a reduction of taxable income for this year for this person of $84,000. And this is just a totally new concept, something we've never had before, and probably an unintended consequence of the new tax law. So it gets even better when you think about the fact that the $55,000 pension contribution, which we've always been able to deduct in the current year, but remember, it's not a total reduction in tax, it's just that the taxes on that money are deferred. So the pension contribution taxes are deferred just like they always have been, but now because we've been able to pick up that QBI deduction, we're reducing this business owner's taxes, taxable income by $29,000 forever. Those taxes are eliminated. It's permanent. It's not going to come back. And by reducing their taxable income by $29,000 at the 37% tax rate, there's a tax savings which is permanent of over $10,000. Certainly, probably enough to sponsor that pension plan and save the administration and investment fees. So taking it a step further, and this is the same example, except I've said this LLC is more profitable. Their pass-through profits are $250,000. The owner is still single, though, and is going to completely be phased out of their QBI deduction because of the level of pass-through profits that they have in the total taxable income. So in this case, I kind of maxed out on my defined contribution plan at $55,000. So I turned to a cash balance plan where I know I can put in contributions far in excess of what I can do in any defined contribution plan. And so this assumes we have a cash balance contribution of $100,000. That $100,000 reduces the net taxable income for this owner under the $157,000 threshold. So I'm down to 150, under the 157. So I can now pick up a full 20% deduction on my taxable income. So the taxable income after the QBI deduction, after the contributions, is lowered to be 1/3. Yes. So for the contribution of $100,000, we've got a reduction in taxable income of 1/3. And again, we have to sort of look at the distinction between the two. The $100,000 pension contribution allows us to defer tax on that amount. I get the current year tax deduction and I get a long-term deferral, but the $30,000 of additional that changes the taxable income again is eliminated. It's just a reduction in the tax, and I get a tax savings of $11,100. So that's really how the tax law has impacted business taxes, and I think there's really three important ways to think about the interplay between the new Tax Act and the deductions for their retirement plans and the effect that it's had. There's three important things to understand. Kind of the good, the bad, which is not so bad, and then some ugly. The good is what you're seeing right now. This is new. This is something that we never thought would really happen, but it did happen this way. And if you can find a prospect that has this kind of a fact pattern, stick near them because you can really help them to find the retirement plans that can help them enormously on their taxes. So this is for sure the good. The bad really was all the hype in the media about how retirement plans might go away because tax reform would lower all the tax rates. Well, the bad is really not so bad. We talked about how corporations have definitely, the leveraging has gone down some, but the personal tax rates and the brackets have gone down as well. And it's very possible that on an individual basis, that tax leveraging may very well exist for a lot of corporate owners. And for pass-through entities, if they are not, if they're, the service businesses that are very profitable, they really don't have the tax leveraging. They never did. And so not much has changed for them other than the small change, reducing the 39% tax rate to 37%. So again, the bad's not so bad. There is a little bit of ugly that you want to be aware of, and that is this, right there. Those are the businesses that qualify for QBI even without a retirement plan in place. Because they've effectively reduced their taxes, whatever they put in a retirement plan is going to reduce their QBI deduction. And so the analysis is a little bit different for them, and their tax advisors really need to look at a plan versus no plan analysis very closely. I don't think all of these businesses are going to do so bad by not having a plan or that they'll necessarily abandon the plan. There's still all the other benefits of a qualified plan, meaning forced savings and a good disciplined way to save for retirement, providing an employee benefit to help you attract and retain employees. And that numerical analysis of plan versus no plan is very sensitive to what you think the tax rate will be when, in the future, when the money is distributed, which could involve another tax change. So that's probably the worst we see, the worst scenario that we see coming out of this tax reform bill. So in summary, the new tax law reduces taxes on many businesses, but it really has little effect on small businesses with substantial profits that are not really benefiting from a tax cut. Certain businesses, like we saw in the example, that manage to the QBI threshold will get even bigger benefits than they've had in the past. And that's an important thing to understand. And as we said, the cost-benefit analysis really needs to be looked at closer for C corporations to understand maybe what will the owner's taxable income look like in retirement to see if this is really a good thing for them. And pass-through businesses that are below the threshold and are eligible for the full 20% QBI, they want to think about what they're getting for tax deductions or how much they're putting in their retirement plan. So it's important, more important than ever for our clients and your clients to partner with their tax advisors to help them not only choose the right plan, but maybe even maintain the plan they had, but perhaps change how much they can contribute to their plan, especially when they're trying to manage to the threshold. So congratulations, everybody, you're all right. Everybody wins the poll. What was the prize, John?
I think we were debating that, so prize to be determined later based on whoever answered first. But I think it's great when a actuary tells me I'm all right. So that's a good sign. I think one of the last things you just said about embracing the relationship or engaging the tax advisor, that's critical for advisors anyway for a center of influence of gathering clients. But I think as just demonstrated with Joan's expertise, and we have actuaries that they love to have this conversation, if you get to this level of analysis with a business owner, you're really going above and beyond. And by embracing that CPA, the best thing, or tax advisor, so that way you get to that level of detail, you're really going to build a long-term client. And even if it doesn't fit today, you start the conversation and then it becomes more attractive over time. So I think that's something that we like to say, back to the building blocks, maybe it's a 401k safe harbor plan and maybe you add new comparability. That's fantastic. Well, then the next layer up is the cash balance. And it may be that 50, 55 threshold as they approach their normal retirement age, and their tax advisor, if they're working in sync with the advisor, then it's a win-win situation. One of the things that we wanted to briefly cover, and we've got some questions coming in, and some of those came in via text, and so that's kind of comical how these national webinars work. But for the distinguished gentleman in Connecticut, one of the things that comes up frequently is SEPs and simples. If your client currently has a SEP or a simple, those are designed to be the single retirement plan source. So one of the things we like to remind is 60 days before year end, you would terminate that simple. There's a form on irs.gov to be able to put in that termination, and then you would start your traditional 401k plan and cash balance effective 1/1/2019. You can still do both safe harbor this year and cash balance this year, depending on the current provision. So if you have an existing plan, one of the things we like to give our actuaries is the existing plan document along with the census, so they can quickly review it and say, look, this isn't going to be as efficient to start in 2018. It's better to start 2019. But if there's not a plan in place, or there's a plan that's easy to amend, we can still work on the plan this year. The last key component is you can have a new cash balance plan up until the end of 2018. So we like to say, avoid the rush. Labor Day weekend, this weekend, all of us that are toiling hard, and make sure our bosses know that, we get the weekend off, and this is the perfect end of the summer. That's when it's a great time to review your pension plans, your 401k plans, and look at new provisions. So once Labor Day weekend's over, September is a perfect month to really get into these conversations, especially if you're going to involve the tax advisor. He or she needs time to run some illustrations as well to see what it's going to do for the business owner. So we put a few dates out here, and if any of these you need us to expand upon, your Epic Sales Consultant will be happy to answer it. And we involve Joan and the team of actuaries when we gather all the information and prepare it, and we're there to help you all along the way. I guess the caveat, since actuaries don't like to work 20-hour days the last week of the year, the sooner the decision is better. So if we can get those conversations started, and realistically, if we get the decision in October, that's a fantastic time, because then that gives us plenty of time to get those notices out, QDIA, safe harbor, all of the different items, and get the paperwork done, because you know how compliance is. So that kind of wraps it up, and we'll go to questions. I believe we've had some submitted, so I need to look at the poll here. So let me see if I can get to that. Let's see. And Chris, you may have to help me. So it doesn't believe I have, I don't believe it's given me access to the responses. So does that mean we have no questions, or does that mean I don't see it?
We have one question asking whether there's a preference between defined benefit or cash balance. And, that's the only one so far.
Fantastic. So Joan, from my standpoint, we do both. So I think it really depends on the entity. So do you want to take that one?
Sure. We have a little bit of a bias. We have no preference. As John said, we do administer both traditional defined benefit and cash balance. We don't see too many new traditional plans being established. Cash balance plans just are a lot easier to communicate and for participants to understand. The limits on both of them are the same. So if someone's trying to maximize contributions, you're not going to get any more out of one versus the other. They're both defined benefit plans underneath. There was a time when you could not get a pre-approved IRS document on a cash balance plan, so there was a slight preference to go to a traditional defined benefit plan. That now has come to an end. The IRS now has a pre-approved program for cash balance documents, and so now we can provide them, and Epic does have one, and so now we can provide them just like we could on traditional DB plans. So definitely we see the popularity is on the cash balance side. If there's a particular reason a client has a preference for a traditional DB plan, we can do that as well.
And I think it also ties into the investment structure, knowing a liability-driven portfolio from a traditional DB versus relaying that, as you said, Joan, to the participants. It's kind of easier to explain how that works and maybe easier for advisors. And then also that rollover functionality to an IRA really helps with the decumulation, which I think is kind of more normalized for wealth managers. So I think that's another attraction to it, but we do both. So do we have any others, Chris?
We have another question asking if cash balance plans are insured by the PBGC or require premium payments.
Again, yes, many of them are covered by PBGC, but there is an exemption for any defined benefit plan for basically professional service companies that have less than 25 active participants in the plan. They are exempt. PBGC will not cover those plans, and so they don't have to pay premiums. They're not covered. And there are pros and cons to being PBGC covered or not. Everyone knows about the premiums and wants to avoid it if they can, so they like not to be covered. But they should, you should realize when talking to your clients that if a company is not exempt from PBGC coverage and they do have it, they do pay the premiums. But there's also some benefit in that they will have the opportunity for larger tax deductions between their cash balance or defined benefit plan and their 401k plan. There is a deduction limit when you have two plans, and that limit is higher if you're PBGC covered.
That's it for questions.
All right. Well, we thank everybody for joining us today, and we hope you have a very nice and happy and safe holiday weekend. And since I'm here on the sunny Gulf Coast and Joan's, I guess, on the steamy Maine coast, as you put it, we've got most of the country represented. So we thank you for your time, and we will be sending out some follow-up information. If you have any questions, please reach out to your regional sales consultant. We're here and happy to help you. Thanks for joining.